does take us to our talk of the tape. The year ahead for your money, as some bulls suggest, this market can keep running well into 2024. One of those optimists, an uber one at that, is Tom Lee. He's Fundstrat's managing partner, head of research, back with us at Post 9. Welcome back.
Great to be back, Scott.
All right, so before we get to where you think we can go, you were pretty right as to where you thought we would be, right? 47.50 was your target for the end of this year. We're at 46, we'll call it. You said mega cap was going to lead the way. In fact, it has. Why do you think things have gone right for you and investors and bulls for the most part, especially lately?
I think people were fooled by the yield curve at the start of this year, thinking we'd have a hard landing, and they didn't want to fight a Fed, but they're forgetting the Fed was fighting an inflation war, not a business cycle. So our bet was inflation would be softer, you'd avoid a hard landing, and then we've seen the Fed kind of take its foot off the neck of monetary policy. So I think it was economists were too bearish, and the technical picture turned positive very quickly. It was a triumph of technicians.
Yeah, it's not over yet, right?
No.
And there are those who still say that the cycle's going to end because of what the Fed has already done. We just haven't seen it yet. You've heard that. How do you respond to that?
I think people should study market internal structure. We've seen a huge turnaround in cyclical stocks. The banks are churning. The regional banks are turning up. Small caps are leading. This is not end of cycle market behavior. This is early cycle expansion reaccelerating.
What if it's just a late year, run as fast as you can, catch up to what you missed? A lot of money has come in and it's just chasing everything to the end of the year as rates have come down.
Well, if we thought this was a head fake, and I think if this is 98, we can run another 7% from today.
To when?
To year end. But
this year end?
Well, I think 4,800 is more reasonable, But I think that if it was a head fake, we'd see credit calling baloney, and we'd see spreads widen or high yield falling. But what's happened is spreads have rallied, high yields rallied. It's actually a improving liquidity rally while investors took $240 billion out of stocks this year.
So you're a believer in the broadening of the move, and you think it carries beyond the calendar turn?
Yeah, because now as we get into next year, we'll have an FOMC decision, but I think it's going to show the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. Huge change. I think interest rates could make a huge move lower. Mark Newton, our technician, thinks it could be 3.5%, 3.2%. And that would take mortgage rates down to 5 or under 5%. We know that would help the economy, and I think there's a lot of pent-up demand for CapEx. So I'd say that stocks could do very well next year.
Well, you must if you think we're going to get to your target for 2024 S&P is 5,200.
Yes.
What gets us there?
Well, it's earnings recovery. So we think earnings hit 265 by 2025. That's 2 years of like 9% growth. And you put a 20 PE. A 20 PE has happened 50% of the time when the 10 years between 4 and 5%. So it's the most common PE to apply, and that would be 5,200. But I think that's conservative because 265 is 5% of it's coming from cash, right? So there's like 3% organic growth. I mean, cash earnings is 5% growth right now per year.
I hear bears say earnings aren't going to be as good because inflation is not going to be as good for earnings. And that's going to be a negative, and that's why the market's overvalued, and people like you at $260 are just way too optimistic on where earnings are going to be.
Well, I think people should study the PPI. Like 4 or 5 sectors are correlated to PPI, like materials, energy, meaning as inflation falls, they make less money, but tech and industrials have almost no correlation to inflation. And then financials are positively correlated. So I think you have more groups that could actually have better earnings power into next year, and especially if caution comes off companies. CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
So the market thinks the Fed's going to cut first in March, 3 meetings from now. Is that what you think?
I mean, to me, that intuitively seems aggressive, but what's going to matter more is what the bond market starts to price. And I think the two-year is telling us the Fed does have to cut meaningfully next year, because if they don't cut and inflation weakens, the level of real Fed funds is associated with a hard landing. Like the Fed, if they're trying to manage the business cycle, would be cutting rates.